And it's a big week for investors with a long anticipated Fed rate decision on Wednesday, large cap tech results in the shape of Microsoft, Alphabet, and Meta. Our next guest says the air is getting thinner for further gains, especially in equities, but the macro backdrop and a likely positive second quarter reporting season still supports a continued risk-on stance. Joining us now is Max Kettner, HSBC Chief Multi-Asset Strategist. Max, it's good to see you. Good morning to you. So it sounds like you're sort of trying to weigh the bullish and bearish factors right now. And it sounds like that balance is a little more delicate than it has been. So talk us through kind of how that scale is working for you.
Yeah, good morning, Julie. I think, it's been a bit, it's got a bit more delicate now, because when we look a couple of months ago, I think particularly on the sentiment and positioning side, it was very, very clear when we looked at all of our sort of shorter term sentiment and positioning signals, they were very depressed, right? So we saw really sort of systematic positioning, discretionary positioning, options-based positioning, ETF-based positioning, all this sort of stuff was really depressed. We had very, very depressed growth forecasts. And then it was sort of easy for us to really proclaim and really tell that the bullish narrative. I think when we look now, for example, at things like the pricing of equities versus fixed income, look at equities versus the 10-year, for example, that's sort of starting to price a global PMI of 52. It's quite a chunky recovery already, right? So there needs to be some confirmation now. We do think there is perhaps a little bit of upside risk really for global manufacturing. A couple of those leading indicators, particularly for US manufacturing, have picked up lately. And I do think that particularly now the earnings season, particularly the US Q2 earnings season, that's going to be also a near-term catalyst. But after that, and after, perhaps manufacturing even's picked up, I think then it's getting a little bit thin for risk assets for further gains.
And so we've tried to kind of pair this with where we're at in this kind of broader inflation cycle. Where would you say that we're at, Max?
I think we're still in that disinflationary Goldilocks cycle. So for us, it's still the stage at, the investment or the inflation cycle where I want to play that disinflationary theme plus growth actually doing quite fine, right? Yeah, of course, manufacturing is still sort of the weak spot, but if you look at the consumer's doing fine, the labor market's doing fine, right? Real wage growth has been turning positive now for quite some time, particularly on a sequential basis already. When you look at the weaker dollar, that's going to help earnings revisions in the US in particular in the next couple of months. It's also helping, obviously, global growth, right? US housing surprises are running on a 20-year high. And at the same time, as you were asking, inflation is still going down. So all of that is still a very sort of Goldilocks outcome for the market, where you want to be long US equities, you want to be long maybe sort of emerging market ex-China. So in total, it's an environment where you want to be long carry, right? The sort of emerging market debt, high yield credit, and the growth side of things in equities, i.e. the US and a bit of EM.
At the same time, you say you're tactically overweight, which makes it sound like you want to be nimble here. And you also say things could get a little hairy at the end of the summer. What are you looking for as those potential risk factors?
Yeah, but to be perfectly honest, we've been basically saying that we're tactically constructive since the start of the year, and we're sort of just extending our tactical bullishness every other month. So I think the main issue and the main problem that me and the team are really facing is that we're running out of potential headlines to say still bullish and still constructive. So I am a taker of any creative ideas, but we're sort of running out of really particularly bullish headlines. I would say the earliest we're really facing those issues is end of Q3, beginning Q4. If then perhaps, some of those base effects in inflation are turning higher, we'll perhaps see headline inflation in the US pick up again. And then perhaps some of that, immaculate disinflation theme that the market is playing right now, and that perhaps can be questioned. And then, on the basis of that, we might see a bit of a pullback in risk assets. But I don't believe it's anything else other than a short-term pullback that then has to be bought. Because if we do look at aggregate sentiment of the largest real money investors worldwide, which we track once a month, then it's becoming still clear that even with the second half outlooks, that there is still on aggregate underweight equities, underweight high yield credit. So all of that really, really prevents a large-scale drawdown.
So does any of that scream recession to you?
Not at all. Not at all. I think that is very, very clear. Nothing of that screams recession. I think, if anything, the risk is much, much higher that we're going to get perhaps, with, like I said, right, the weaker dollar and US housing surprises on a 20-year high. And look at financial conditions, right? Look at broader aggregate financial conditions. They've eased, whichever index you use, whether you want to take, the Federal Reserve's indices or some others, they've eased, right? They've eased in the last 9 months. And it's no wonder that they did, right? Equities went up, the dollar went down, credit spreads tightened, volatilities are lower everywhere. So that really doesn't scream recession. It screams that we're perhaps closer to things becoming better in the US, not worse.
And Max, just lastly, sort of in sharp contrast to all of this is what we seem to be seeing in Europe. I mean, this morning, for example, we got a European PMI that was not great. So while you like the US, it sounds like maybe you're not looking to home turf.
Yeah, not anymore, sadly. So we're on aggregate underweight European equities, so that's Eurozone and UK, because just as you said, right, like the positive surprise catalysts, we're running out of that. And I think particularly with perhaps a little bit more sort of measured stimulus out of China, that also doesn't really bode well for the European manufacturing sector, doesn't bode that well perhaps for some of those overcrowded trades that we had in the first half. Think about luxury goods, right, in the first half of the year. So all of that, right, and with the Eurozone in particular still being somewhat of a consensus long, right, among investors, that doesn't bode well really for European equities towards the second half. In particular, bear in mind what the weaker dollar is a tailwind for US earning. That also means that the stronger euro now in the second half is going to be a headwind for Eurozone earnings. So that doesn't help either.
Max Kettner, HSBC Chief Multi-Asset Strategist. Max, appreciate the time as always.